Hi, welcome everybody. We are so pleased to have you here with us for our 11th and final session of the day here at Gallagher Talks. This session's topic is captive insurance and the hard market. Our speakers will help you gain insight on the differentiated holistic approach towards alternative risk transfer and how we can add value through our demonstrative expertise. I'm pleased to introduce you today to our speakers, Andrew Hosie, our VP of National Strategic Growth, coming to us from Toronto, and Jeff Kurtz, our Managing Director of Artex. A couple of things to mention just before we get started. You will be receiving a recording of this webinar later this week. And because of the fast-paced nature of our talks today, any questions that you send in via the Q&A box today will be addressed later this week. For anyone on the line having connectivity issues or sound issues, please do check in with us on the Q&A box, and we will be here to reply and troubleshoot with you during the session. We hope you enjoy today's topic, and remember, if you are on LinkedIn or Twitter, please do follow along and share your experience about today by using the hashtag Gallagher Talks. Thank you so much for tuning in today. This session will conclude Gallagher Talks, and we hope to see you again soon. I will now turn it over to Andrew and Jeff.
Thanks so much, Kelly, and just reiterating the words of welcome to everybody on what's been a fantastic day of informative sessions. For the eagle-eyed viewers amongst us, you'll see that we're not joined by Mike Woytowicz, but we're joined by Jeff Kurtz. Mike is based in Bermuda in Artex's Bermuda office, and obviously they've been significantly impacted by the hurricane over the past couple of days. We wish everyone in Bermuda well. We're pleased to hear that most of the Gallagher family and on island have come through unscathed. And, pivoting is the word of the term at the moment. So thank you very much to Jeff, who is a managing director of Artex in our Rolling Meadows office, with over 25 years of captive management experience to join us and to step into Mike's place. And we'll look forward to just continuing as normal. So thanks so much, Jeff.
My pleasure, Andrew. And for all of those that are watching and listening, you can see Andrew, but you cannot see me. My webcam was not working. But suffice it to say that had Mike been on the phone, you would have gotten a better view of me than him. But no, as Andrew said, we wish them all well, and everything's great down there. So happy to be able to fill in and have this discussion with you folks this afternoon.
Great. So, Jeff, I know captives is proving to be a very timely topic. And, as we sort of address everybody on the call, certainly in the Canadian landscape, all of the questions in the agenda today are very pertinent, top of mind in the current hard market, pandemic or no pandemic, with just understanding what a captive is, in terms of, is it a sexy insurance solution and just a way to go off island and onto the Caymans and in Bermuda and Barbados every couple of months? The need for a captive, particularly in the hard market, how organizations can use a captive, why they should consider them, and sort of the domiciles of choice, concluding, with certain opinions and professional insight, Jeff, as to sort of why we can use a captive and the benefits and sort of pitfalls of considering captives in today's current market conditions.
Yeah, great. So thanks, Andrew. So, I think in a hard market, certainly, as we all see and understand the hardening conditions in the market in general, and it is cyclical over periods of decades over time. But, the old adage of in soft markets, you buy insurance, and in hard markets, you retain risk. Obviously, that's a way to be able to mitigate where the pricing is going. And for companies that have both the willingness and ability to retain risk, they can mitigate some of that pricing by utilizing that strategy. But many of them also then go down the next path, which is to utilize a captive insurance company to formalize the layer of risk that they're taking on. And while there are many myths and legends and misconceptions about what a captive really is, we really want to distill it down to the fact that it is a regulated and licensed insurance company. either in in the U.S. There are 35 U.S. states that have captive legislation, but traditionally it's been more offshore, as you said, Andrew, with Bermuda, Barbados, Cayman, that allow owners of companies to be able to set up their own insurance company to provide for a layer of risk for themselves versus buying that insurance from a third party. So it is truly a licensed and regulated insurance company, and it can provide significant benefits as it relates to the amount of risk that somebody takes on. And I always say I never want to have the captive tail wag the insurance dog. We certainly want every one of our clients to be able to understand what's the right amount of insurance for them to buy, the right attachment points, the right amount of risk transfer versus risk retention based on where the market is. And that's the first question, first and foremost. And then secondly, what's the best way to finance that risk over time? Because we certainly want to be able to allow companies to understand what their total cost of risk over time is and finance that for themselves. But why do companies look and need captives? Well, it's really they're looking for stability. They're looking to be able to say, for the amount of risk that I take on, I want to be able to understand. Oh, I'm sorry, was that? I think we skipped some slides there. Sorry. So they really want to have some stability of their pricing. So they want to, by retaining more risk, be able to utilize the captive to retain a layer of risk. And if you think about risks that are similar to property, which are non-severity driven, or severity driven but non-frequent, if I were a CFO or a finance director of a company and I knew I was likely to have a large loss sometime in the next 5 to 10 years, well, I've taken on a large deductible or a self-insured retention, but I just don't know where that large loss might come in. So if I was likely to have a $5 million loss sometime in the next 5 years, I would rather pay my captive insurance company $1 million a year with the buildup of investment income in the captive than absorb that $5 million loss in a year I can't predict. Because I want to build in that cost of insurance into all of my operating metrics, whether that's cost of goods sold or my real estate pricing, whatever that might be. And so companies use that as a mechanism to be able to finance that risk better over time, reduce volatility. But a captive can take on, because it is a real insurance company, and jump in here, Andrew, if you want to ask a quick question in the interim here before we switch slides.
Yeah, I think the big thing in the Canadian marketplace is that people are seeing obviously great increases in premium, shrinking capacity, and they're using the captive discussion as a way to sort of leverage the domestic markets as well as control their own costs. Maybe you could elaborate on sort of how the current domestic marketplace are sort of almost forcing the captive conversation and the pros and cons of doing it that way.
Sure. Yeah, and I think you're right. They are forcing the captive conversation because not only with the higher premiums, but also with required higher retentions, differences in conditions, additional exclusions, especially as we've all seen over the past 6 to 9 months with the COVID issues. They're really forcing companies to go towards a large retained risk model, and so. Having the captive as a way to be able to say, number one, I would like to be able to take on a large amount of risk, but I may have contractual requirements or bank covenants, et cetera, that dictate the amount of risk that I can take on. So having a fronting company, which would offer a first dollar or guaranteed cost policy with the captive sitting behind it as a reinsurer, is really almost a necessary evil for folks that are required to be able to take that level of risk based on where the market is. But also from the perspective of saying I want to access some real risk transfer on a different basis. So whether I want to replace an excess layer where the rate on line may be 30-40%, I'd rather retain that layer and have the captive be able to finance that for me versus transfer that, as well as the potential of the captive directly accessing reinsurance markets. And so while we all know the different lines of coverage that are distressed right now, from property to auto liability, professional liability, professional indemnity, et cetera, anything that is moving towards a very hardening market and larger retentions that make sense are really where clients are looking to establish a captive to be able to fund that layer of risk.
And again, recognizing sort of the need for captives versus the wants for captive, Jeff. And apologies for anyone who's seeing the technical difficulties with the slides checking up about. Many organizations in Canada are using captives right now because they think that is a much more affordable option based on expiring premium or the foresight into the next premium. How might you dispel that sort of myth, if you like, whereby one offers a much cheaper option and vis-a-vis the concern is an inferior insurance product?
Yeah, so we always look at, or at least at Artex, we kind of start from the perspective of saying, what insurance is really access to capital at a deeply discounted rate. And until such time as that rate is no longer deeply discounted. And so you look and say, well, if I really am seeing significantly increased pricing, is there a way for me to be able to take on the risk that I understand I can control, I'm willing to take on, versus buy insurance at a high double-digit increase this year? And so if you think about it from the perspective of saying, for any dollar of insurance, inherent in that is the losses the insurance company is taking on, because if I can see the losses, the insurance company can see them. They're just charging our client for them. But they're also building in their expense load. They're keeping investment income from the time the premium is paid to the time the claim is paid out, and they're returning underwriting profit to their shareholders. And so intuitively, if I were to be able to say, I understand and I can control the risk, I have a balance sheet to be able to accept that risk, for every dollar of loss that I have, it's going to cost me anywhere from 30 to 40% less to finance that risk over time than to transfer that to a third party. And the same is true of excess coverage. As I said, if somebody's looking in auto liability for maybe a $3 million X of a $2 million primary, if that's going to be 25-30% rate on line, and the losses support the analysis, then I would rather say, well, if I put those dollars in my captive, I could fully fund that limit over a period of 5 to 6 years potentially, versus paying the premium. And if you look at it from a financing perspective, would I go out and borrow a contingent $3 million at a 25 or 30% interest rate? No, we wouldn't. But you could. But if you're accessing insurance at that pricing level, then it makes more sense to be able to self-fund that, as long as, again, you can control, understand the risk, and that the loss history supports accepting that risk versus transferring it to the market.
Great. So once you've established that there's a need, Jeff, and an organization understands sort of the benefits that you've just explained, could you elaborate on sort of how captives are used, and leading on to the slide after that, where captives are most used, or you're seeing an increase in their applicability to our clients?
Sure, yeah. And captives are traditionally used for the ability to finance that risk. I would say that they're not a market of last resort. So if a client has really bad losses and really bad financials, and the premiums are going up, well, a captive solution is not the magic wand here. We can't fix bad losses and bad loss control, bad risk management. But for the clients that do have good risk management, they're unfairly maligned in the market. That's really where they come into play. And again, it's to be able to take that layer of loss that they're willing and able to assume and set up their own insurance company to pay themselves to build up surplus over time. I would say that I'm looking for the domicile slide here, and I apologize for the PowerPoint. It's not working very well for us here. But to your point, they would traditionally look to various domiciles, traditionally offshore. Again, Bermuda being the biggest and most mature, but with Cayman coming in right behind that. And then certainly for Canadian clients with the close relationship historically to Barbados. Barbados has a disproportionate amount of Canadian captives based on not just that relationship, but also the dual tax treaty that was put in place many years ago. But that being said, Bermuda and others have gotten themselves on par with that over time. But Bermuda still being the largest by far. And Cayman, I would say, is while it's a close second, is there, I would say 2/3 of the companies there have healthcare-related risk, both in the U.S. as well as Canada and other international domiciles, because they understand that. But and then the rest are, as you see, in the U.S. till we get down to Guernsey, Luxembourg, and then Malta, Gibraltar, Singapore. Others are there. But I would say for a Canadian client that the choice really comes down to the top three, which are Bermuda, Cayman, and Barbados. Making sure that we're not setting something up in the U.S. that might have an adverse tax consequence related to that there. The one thing I would mention is that one of the great things about Bermuda and Barbados is they have the potential to directly access both Bermuda and London markets in the form of reinsurance that might allow a client, especially with a large property risk, to directly access reinsurance and provide greater stability of capacity for large programs. And as a result, having that direct connection offshore is usually attractive.
Yeah, and recognizing the audience, Jeff, and before the hotline starts ringing, there is a captive component within British Columbia and Canada, but certainly on the volume size, they're still playing catch up to the traditional players in this space. Would you agree with that?
I would, and I would say that would be on par with many of the U.S. domiciles like Vermont and South Carolina and others, which may be good for some domestic risk, and certainly any tax benefits from doing that domestically would have to be discussed with independent tax advisors. But one of the things that I look at is whether or not a captive domicile has maturity and flexibility and the ability to understand the business, because to me, captive regulation is much like insurance underwriting. It's the value of information. And an insurance underwriter, if they don't understand the risk, that's going to represent itself in the form of higher premium. If a captive regulator doesn't understand the particular risk, that's just going to cause them to have the instinct to regulate more, and additional regulations equal additional transactions, and that equals cost. So while Artex and Gallagher, we're agnostic and domicile neutral on it, we always want to propose to the client the pros and cons of being domestic there in BC or looking at an offshore domicile as a potential option.
Okay. So once we've established if we're working with our clients as we do, or you're an organization that believes a captive could be right for you, and we've established sort of, the need over the domestic availability of insurance. And, we might have a holiday home in Bermuda or Barbados, Jeff. What would be the sort of the top 5, top 6 high-level check marks that any organization could inwardly look into to make sure that a captive was the right way that they should be going?
Yeah, I think the key is, do they have, if they're going to take on risk and do that with a captive, do they have a really quality risk management, loss prevention, safety programs so that they have the ability to control the risk that they're taking on? Nobody ever washed a rental car. So, once it's yours, it's, you could pay more attention to it, and it has a positive impact on your bottom line. And that's one of the qualitative benefits that a captive has. It has a direct connection between your risk management program and your long-term cost of coverage. But so, that mentality of that loss prevention, risk management. Secondly, would be, do they see it as a long-term view? This is not, as I said, a market of last resort where you're trying to jump into a captive because the market is hard, and then as soon as it softens up, you want to jump back out. That's not really been successful with clients over time. It's a long-term strategy to say this is a position we're taking for the long term to gain more control for ourselves versus the insurance market. And then I would say third, they have to have a strong balance sheet to be able to do it. In some cases, setting up a captive is not going to be potentially lower cost in year one. You're going to pay the third-party insurer a certain amount of premium, but you're also going to pay your captive some premium. So it's not going to be a cash flow benefit on day one. The savings comes from the long-term proposition of the premiums you pay to your captive versus the losses that don't occur. So you get underwriting income back. But if they think they're going to save cash flow on day one and jump in and out of it, that's not the right mentality. It's got to be a long-term deal, and they've got to have the balance sheet to be able to support that. If they're financially distressed, if they're not a good credit risk, if it's a tough industry where they're in today's world especially, the industry is very distressed, that may not be the best place for it, even though they want to save money on their insurance. Of course, everybody does, but it's got to be somebody that has a balance sheet to be able to accept the risk that they're willing to take on. So I think those would be really the top 3 for me, Andrew.
Yeah, and I mean, we're seeing a lot of inquiries from Canadian businesses. Again, they're getting sticker shock on premium. They're, wanting to absorb some of their own losses. They're wanting a stronger balance sheet. Cognizant of our time, Jeff, as we wind down, could you give a brief example of maybe the sort of last hurdle that some Canadian companies are failing to clear that might stop their ability to look into a captive?
I think in one sense, it's while everybody is seeing premiums go up, double digits, depending on the industry, it's just the reality is that many of those companies are too small to be able to retain risk significantly. Because the insurance companies, if you went to a large self-insured retention of, say, $500,000, $1 million, whatever that is, the premium break on that might be for somebody that's already paying $150,000 to $200,000. To their business, that's real money, but taking on a large retention really isn't going to benefit them as much as it is going to impose significant risk to them for the amount of that risk that they take on. So unfortunately, even in a hard market where everybody wants to find ways to mitigate their risk, sometimes clients just aren't big enough, and sometimes the numbers just don't work out to be able to afford them the opportunity to do that. So I would say that's number one. And then number two, it's having a strong balance sheet to be able to absorb the risk. As I said earlier, you may have the need for a fronting company because you need evidence of insurance, and that there are significant collateral requirements and capital requirements. And when it comes down to it, they don't have the the stomach or the balance sheet to be able to do that. And I think that's really the biggest deal. And the third would be that the excess markets are, as we all know, going haywire by the day. And so do you really do you have somebody that if you took a large retention or you want to access reinsurance directly, are you in an industry and the right profile and the size of premium that's going to get attention from those markets? And sometimes the answer is no. We all know there's limited capacity. We know that it's a very selective market. And so even though we think one of our clients might be a good risk and they're willing to take some risk, we might not be able to find effective or cost-effective excess or reinsurance that makes the deal work. But for the right group, the good risks that are unfairly maligned, in a tough industry but with great loss history, that's really where the arbitrage of taking on the risk in this market really works out. And a captive can be a good way for the right fact patterns that might give them some relief.
Yeah. So on a feasibility perspective, captive decision-making is industry agnostic at the time being. And even in a bad industry, there's always the sort of cream rises to the top in terms of acceptability to the regulator.
Yeah, that's absolutely right. Yeah.
Perfect. And I mean, Jeff, in closing, we certainly don't want anyone to be put off, the Canadian captive environment, because obviously you touched on Barbados and Bermuda being sort of the number 1 and 2 go-tos for Canadian organizations. Certainly don't let the hurricanes of this week put you off having to go to Bermuda or Barbados 4 times a year. But would there be anything in closing that you would really recommend to those people considering a captive as a sort of first step?
Yeah, the key thing is to really identify the lines of coverage that are causing the biggest issues. And so we want to identify those in sort of a mini enterprise risk mapping sort of project. And then, we want to understand, is it big enough to be meaningful? Is there a solution for it? And then once we understand the lines of coverage that are really driving the problem, then we need to quantify that and look at the retained losses, the loss history, and the feasibility analysis is really where we start with that, which is to get an actuarial analysis of that, understand what layers of risk actually make most sense for the client to take on, and really build a captive design through that feasibility process. And while there might be multiple things that a client may want to do, we really need to distill it down to the things that are most impactful, because not everything, as I said earlier, might not be big enough on a per line basis to make sense. And I think we had a question that came in regarding minimum premium for a captive to be feasible. And I think if we look at it from a monoline perspective, I think it needs to be in the $1.5 million. If you look at it on a first dollar basis, to be feasible, and that's really where the excess or the reinsurance markets might actually have some relief. But for the groups that are in the 500, 600,000 range, to be honest, it's probably not going to make a whole lot of sense after paying for the cost of setup, et cetera. And then we did have one quick question on D&O. And while we all know the D&O market is highly distressed, the only way that we're using a captive is for the organization to take a large retention and fund that within a captive. To be clear, though, it becomes a little bit more difficult because the Side A coverage can be a challenge. Because if you think about an organization that's going to get a D&O claim, potentially as it relates to a bankruptcy, the assets of the captive will likely not be bankrupt remote, and as a result, those would be drawn into the bankruptcy proceedings, and there would be nothing left to protect the directors and officers. So we can do it on a side B or other potential layers, but it can be done. It is being done, but it can come with its complications.
Great. Thanks, Jeff. And again, thank you so much, Jeff, on behalf of Gallagher in Canada for stepping in and sort of as we wish Mike and the island of Bermuda well. Difficult to squeeze everything in such a short period of time on such a broad and top of mind topic. But thank you for everybody for joining today, and certainly we'll look forward to providing answers to all of the questions posed. And Jeff, we'll certainly be looking forward to seeing you in Canada sometime soon.
Can't wait to get back up there, Andrew. And again, I appreciate your flexibility with us for me joining in Mike's stead, and wish you all well.
Great. Thank you, everyone, for joining, and have a great evening.